Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Nio.
You find our talks useful? Please consider subscribe, like, and comment underneath.
And we've got a really interesting audio summary for you today.
Yeah, we do.
Yeah.
Because this is a file that, honestly, I've been a little hesitant to open up for a while now.
I don't blame you.
It's just, well, it's complicated. You're looking at a company that has been the absolute cool kid of the Chinese EV market for years, but also, let's be real, a bit of a financial black hole.
Oh, absolutely. The hesitation is totally warranted. For the longest time, the narrative with Nio was basically, look at the amazing cars, look at the Nio houses, the loyal fans.
Right.
And, please just ignore the bank account.
Exactly. Great designs, but a terrible balance sheet.
Yeah.
But looking at the stack of reports and catalysts we have today, it really feels like that narrative is trying to flip.
It is.
We aren't just looking at another quarter of growth at all costs. We are actually looking at a potential pivot to real-world profit.
And that is the massive headline shift here. Because after years of burning cash to build out all that infrastructure, Nio has officially guided for its first ever adjusted operating profit.
First ever.
First ever, yeah. And that's for the fourth quarter of 2025. When you hear first ever regarding profitability in the EV space, that's a phrase that should make any investor sit up and pay attention.
So that's our mission for today's analysis. We need to figure out for you guys if this is just a one-off lucky break or if Nio is finally growing up into a sustainable business.
Right, a real company.
Yeah. So we're going to tear into the margins. We're going to look at this battery swapping mode to see if it's an actual advantage. And we definitely need to talk about the whales, the big money, and what they're currently doing with the stock.
Let's start with that financial pivot, though, because really everything hinges on it.
I agree. So the headline says profit. But I have to play the cynic for a second here because profit can mean a whole lot of different things in corporate accounting. What are the actual numbers we are looking at for Q4 2025?
Okay, so the official guidance is for an adjusted operating profit somewhere between 200 and 700 million RMB.
Okay, and in dollars.
If you convert that, we're looking at roughly 29 million to 100 million US dollars.
29 to 100 million dollars. Now, look, in the world of automotive giants, Toyota, Tesla, GM, $30 million is essentially a rounding error.
Sure.
It's pocket change. Why are analysts treating this relatively tiny amount like it's the second coming?
Well, it's all about the trajectory. You have to look in the rearview mirror to understand it. Over the last trailing 12 months, Nio's net income was negative $3.3 billion.
Ouch. Negative $3.3 billion.
Exactly. They were bleeding out. So to go from a $3 billion annual loss to posting any profit at all, even a modest $30 million, that is a massive structural shift.
It's the momentum.
Right. It's like stopping a runaway freight train and finally getting it to inch forward in the opposite direction. The magnitude of the turnaround is what matters to Wall Street, not necessarily the raw dollar amount right away.
Okay, that makes sense. The delta is huge. But you mentioned adjusted operating profit. That usually comes with some caveats. Are we talking about real cash in the bank here, or is this just creative accounting?
That is exactly the right question to ask. So adjusted often excludes things like stock-based compensation. On a pure GAAP net income basis, they might still be hovering right near the red line or slightly under it.
It's not entirely out of the woods.
Not entirely, no. However, operating profit shows that the core business, literally the act of building and selling cars, is starting to pay for itself. It proves the unit economics are actually working.
Okay, so the core machine is working. But how? Did they just sell their way out of this massive hole, or did they actually slash costs?
It's a combination of both, but the cost side is where the real story is hiding. If you look at their gross margins, in the third quarter of 2025, they hit 13.9%.
13.9%. Just for context, where were they sitting before this?
They spent a really long time stuck in the single digits, sometimes even negative when you factored in all their overhead. Yeah, so 13.9% is getting much healthier. It's not Tesla levels, which historically hovered around 20% or higher, but it is highly respectable. And the big driver behind this is battery costs.
You mean the cost of the raw cells themselves?
Yes. The entire EV industry is benefiting right now from a massive drop in lithium and general battery manufacturing costs. But Nio has also implemented very, very strict cost controls internally. They've essentially stopped all the reckless spending.
They finally tightened the belt.
Significantly. And if you look at Q3 2025, you can see the proof in the pudding. They reported an earnings per share, an EPS, of negative 15 cents.
Which, to be clear to everyone listening, is still a loss.
It is a loss. But here is the crucial key. Wall Street expected a loss of 24 cents. Nio beat that estimate by over 37%.
That's a big beat.
It's huge. In this game, being less bad than expected is a massive win. It signals to everyone that management finally has a firm grip on the steering wheel.
And that naturally leads us to the volume side of things. Because you can't just save your way to growth, right? You eventually have to sell cars. I saw the delivery numbers for late 2025, and they were surprisingly high.
Record-breaking, actually. They exceeded 40,000 units delivered in both October and December.
40,000 a month.
Yeah. And that is the magic number. Auto manufacturing is entirely a game of scale. You have these massive fixed costs, the factories, the robots, the R&D centers.
Right.
If you only sell 10,000 cars, those fixed costs will eat you alive. But once you cross that 40,000 mark, you start to cover that overhead. That's exactly why we are seeing their margins expand.
So the factory is finally running hot enough to actually pay the bills.
Precisely. And that is exactly why analysts are now projecting full-year non-GAAP profitability by 2026. They truly believe the scale has finally caught up to the ambition.
Okay, so the math is finally starting to work. But let's talk about the thing that makes Nio so weird. And I mean that in the best possible way. Their moat.
The battery swapping.
Yes, because basically every other EV maker out there, Tesla, BYD, Volkswagen, they all bet on the plug. Superchargers, fast chargers. But Nio said no. We are going to build giant vending machines that physically swap your car battery in 3 minutes.
Right.
And for years, people said this was a capital-intensive disaster.
Well, to be fair, it was incredibly expensive to build, but now we are actually seeing the payoff. Let me give you a really crazy data point from the Spring Festival in 2026.
Okay.
In a single day, Nio recorded 146,649 battery swaps.
Wait, 146,000 swaps in one day?
In a single day. That is massive utilization of their network. And just think about what that means for the actual driver.
Yeah.
While Tesla drivers or BYD drivers were stuck in these huge queues at charging stations, waiting 30 or 40 minutes for a top-up during the holiday rush, Nio drivers just pulled in, swapped, and left in 3 minutes.
It's literally replicating the gas station experience.
It really is. But the moat isn't just about the convenience factor. It is about lock-in. In business, we call this high switching costs.
Break that down for us. How does swapping a battery lock you in?
Well, Nio pushes a business model called battery as a service. You buy the physical car, but you lease the battery. This substantially lowers the upfront cost of buying the vehicle.
Okay.
But once you do that, you are legally and practically married to the Nio network. You can't take your leased Nio battery and swap it out at a Tesla station. You can't just easily swap it at a generic charger without voiding things or losing the benefit.
So you're entirely in their walled garden.
Deeply in it. If you want to switch car brands later, you have to completely exit that entire ecosystem. It creates a level of stickiness that is very, very rare in the auto industry. Usually a car is just a piece of hardware. Here, the car is a node in a utility network.
It honestly reminds me of the whole iPhone versus Android debate.
Exactly.
Once you have the blue text bubbles and your photos are on iCloud storage, leaving is just a huge pain. Nio is creating that exact same friction.
That's the perfect analogy. And now they are leveraging that specific network with their new multi-brand strategy. This is the other major piece of the puzzle, Firefly and Envo.
Right, the new sub-brands. I've seen the headlines about this. Nio is the premium brand, kind of like a Mercedes or an Audi. And then Envo and Firefly are their new mass-market, budget-friendly lines.
Correct.
But isn't there a massive risk here? I mean, brand dilution is a very real thing. If you start selling cheap cars, doesn't it hurt the prestige of the main luxury brand?
It can.
And more importantly, does it cannibalize their own sales? Why would I buy a pricey Nio if a cheaper Envo gets me the exact same technology?
That is a completely valid risk, and it's something luxury car brands struggle with constantly. But you have to look at the underlying economics. Nio has spent billions on R&D. The autonomous driving chips, the software operating system, and of course those battery swap stations.
Right.
If you only sell expensive premium cars, you have a very limited number of units to spread all those development costs over.
The denominator is just too small.
Exactly. By launching Envo and Firefly, they can shove those exact same technologies into hundreds of thousands of cheaper vehicles. It amortizes the massive R&D spend. It's essentially the Volkswagen Group strategy.
How so?
Well, Audi pays for the high-end tech development, but then Skoda and VW sell the sheer volume required to make that tech broadly affordable.
So the Envo buyers are basically paying for the party that Nio throws.
In a way, yes. And crucially, those Envo and Firefly cars are designed to use the exact same battery swap stations.
Oh, wow.
Yeah, that drastically increases the utilization rate of the infrastructure they already paid billions to build.
Okay, I see the logic there. It's a pure ecosystem play.
Yeah.
But let's take off the rose-colored glasses for a minute here. We've been talking about profits and moats, but there are definitely some ugly clouds in this report, too.
There always are.
We have to talk about the recall.
We do. You definitely cannot overlook that. Nio recently had to issue a recall for 246,000 EVs.
246,000. That is a huge portion of their entire fleet on the road.
It is the largest recall ever by a Chinese EV maker to date.
And this wasn't just a minor trim issue or a faulty door handle, right? What was the actual problem?
It was a screen issue, a safety risk involving the central display console. Now, normally, when a high-growth company has a record-breaking recall like this, the stock gets completely hammered.
Right, investors panic, they think the cars are falling apart, hit the sell button.
Exactly. But if you look at the market reaction this time, it was surprisingly muted. In fact, the overall sentiment remained bullish.
Why is that? Are investors just willfully ignoring the bad news?
Not ignoring it, but contextualizing it. First of all, the first ever profit guidance news broke right around the same time, which provided a massive psychological buffer.
That helps.
It does. But secondly, the market seems to view this specific issue as a soft failure. A central screen issue is likely a software patch, or at worst, a modular hardware swap. It's not a catastrophic battery fire risk. It's not the wheels literally falling off the chassis.
So it's an expensive headache, but it's not an existential threat to the company.
Exactly. It's a fixable glitch, not a deep structural flaw in their engineering. However, I will say it does raise some serious questions about their quality control as they scale.
Sure.
As they try to ramp up to 40,000 units a month, can they actually maintain quality? That recall suggests they are definitely experiencing some serious growing pains.
And speaking of pains, I noticed something a bit concerning in the institutional data. You track the whales, the big institutional funds.
Always.
And RWC asset advisors, they completely bailed out.
They did. RWC sold their entire position in the fourth quarter of 2025. 10.5 million shares. That's roughly $79.8 million they just took right off the table.
Okay, stop right there. If the turnaround is so incredibly real and these profits are finally coming, why is a smart fund dumping $80 million worth of the stock? That feels like a glaring red flag to me.
It certainly warrants caution, but we have to try and get inside the head of a fund manager. They saw a massive run-up in the stock price during Q3 simply because of those strong delivery numbers.
Right.
Fund managers operate on very strict risk management rules. If a stock hits their internal price target, they sell. It's clinical.
So it might just be pure discipline. Just, hey, we made our 30%, we're out.
Very likely profit-taking. But it also signals that not everyone out there is convinced this is a long-term, hold-forever stock quite yet. Some big money clearly still treats Nio as a swing trade. You buy the hype, you sell the news.
Makes sense.
And remember, despite this exciting profit guidance, Nio still doesn't pay dividends. They don't do stock buybacks. They are still a very cash-hungry machine.
Right. They need absolutely every dollar they can get to fund those new sub-brands and the swap stations.
Exactly. Capital is constantly being poured back into the infrastructure.
Let's quickly look at the technicals and the charts. Where's the stock actually sitting right now?
As of mid-February 2026, it's trading just under $5, $4.95.
Under $5.
Yeah.
That is very interesting psychological territory for retail investors.
It is, but it is up over 16.2% over the last year, and we are currently seeing what we call heavy whale activity in the options market.
Break that down. What are the whales doing right now?
We're seeing huge volume spikes in consumer discretionary stocks, specifically targeting Nio. This strongly suggests big players, maybe not RWC, but other big funds, are positioning themselves for volatility.
Yeah.
They are betting that the upcoming earnings report is going to move the stock significantly one way or the other, and given the current sentiment scores, most of that positioning seems to be skewed to the upside.
They're expecting a pop.
The new sentiment is overwhelmingly bullish right now. The narrative of the turnaround is incredibly powerful in the market. Investors absolutely love a redemption arc.
Okay, so if I'm listening to this today and I'm trying to figure out exactly when the rubber meets the road here, what is the date I need to circle on my calendar?
March 20, 2026.
March 20th.
Yes.
Yeah.
That is the Q4 2025 earnings report.
And what's the one number or the one key metric that everyone needs to be listening for on that call? The consensus is expecting an EPS of -7 cents, right?
Right, -7 cents. But honestly, the EPS beat isn't the main event. The only thing that really matters is the hard confirmation of that exact profit guidance.
Okay.
Did they actually hit that $29 million to $100 million operating profit range?
Because if they miss that, after explicitly guiding for it months in advance.
It would be absolutely catastrophic for management's trust. They have to deliver on that promise.
Yeah.
And the second thing to watch is the forward guidance for 2026 delivery growth.
What are the expectations there?
There are a lot of rumors swirling about a 40 to 50% growth target.
Wow. If they can promise 50% volume growth and actually maintain profitability.
Then the entire stock re-rates. It
Yeah.
suddenly stops being valued as a speculative EV startup
Yeah.
and starts being valued like a real mature automotive business.
All right, let's wrap this up with a final verdict. You've looked at the good, the bad, the recall, the margins.
Yeah.
On a scale of 1 to 10, where 1 is run away and 10 is back up the truck and buy the stock, where do you stand on Nio right now?
I'm giving it a solid 8 out of 10.
An 8. I have to admit that's surprisingly high given the recent recall and their long history of cash burn.
It is a high score, but here is the core thesis. The inflection point to actual profitability is the single hardest hurdle to clear in hardware manufacturing.
Yeah, that's fair.
And they finally seem to have cleared it. Combine that inflection with the undeniable moat of the battery swap stations, the record usage we saw during the Spring Festival, and the massive volume ramp coming from Onvo and Firefly.
The pieces are coming together.
They really are. That old Tesla of China comparison is finally starting to mature into a real sustainable business rather than just slick marketing hype.
It's a really compelling argument. It's a great setup for a swing trade into earnings and potentially even a long-term hold if that 2026 profitability actually sticks.
I agree completely.
But I want to leave everyone listening with one final thought to mull over. We spent a lot of time today talking about their moat, the battery swapping. Nio is basically betting the farm on this technology.
Right.
But standard charging tech is getting radically faster every single year. We have chargers hitting the market now that can take a car from 10 to 80% in maybe 15 minutes.
That is very true. The gap is closing.
Exactly. So the big question for you guys is this. In 5 years, does a 3-minute battery swap still actually matter if plugging in only takes 10 minutes? Is Nio building an incredible moat, or are they building a moat out of sand against companies like BYD?
That is the ultimate billion-dollar question.
Think about that. Do you think the battery swap moat is enough to hold off BYD in a long run? Let us know what you think in the comments.
Would love to hear your take on it.
That's all for today's analysis. Thanks for hanging out, and we'll catch you on the next one.